I'm Candice Jackson, and I'm one of the people that Cindy was talking about when she said that people continue to work. I love what I do, so I have 38 years of state service. And most people are thinking that 30 is a magic number, and it is a magic number, but you have to determine when retirement is right for you. And so that's part of what we do today, is to help you in your, not just your planning, but to start thinking about retirement. And I can say that working for the Teachers Retirement System of Georgia, I'm very proud to work for an organization that puts its customers first. We've become faster, friendlier to all of our memberships. In fact, we have an very, very aggressive director in our communications division, which is Winston Buckley. He's here today. We're on, not only do we have members, we have followers. We're on Facebook, we're on Twitter, we're on YouTube, and a lot of Spotify, and a lot of our information can be obtained from there. And so part of what we're doing today is to give you resources, but we're also talking about how you can start thinking about retirement. And one of the things that I always tell people is to think about the quote from Benjamin Franklin. And that is, if you fail to plan, what happens? You plan to fail. And it's all about planning. And that's why we bring these series to you today. So let's get started. Part of the workshop overview is we're going to talk about retirement plan options, creditable service, and beneficiaries. We get a lot of questions because there's a lot of things that people want to know when they're starting to plan for their retirement. And one of those things, basically there's 4 things. The first thing is, am I eligible? The second thing is, what type of plan should I choose for myself and my family? And then how much money would I receive, and how do I apply for retirement? So let's look and talk about the benefits of membership. At TRS, back in 1943, the legislators decided that they were going to put together a program that would make sure that our educators were in a position that they had enough funds to live comfortably in their retirement. So they made it law that you become a member of TRS. A lot of people ask us, can I take a loan on my retirement? No, you cannot, only because we're trying to make sure that you're going to be secure in your future. Also, your benefit is not tied to the market. I know you all remember, if you flash back and think about 1998, there was a crash. So if all of your money was in the market, people lost their money. And so with TRS, you don't have to worry about the market because we're going to pay you a benefit for the rest of your life. It's guaranteed. And if you choose a survivorship plan, your beneficiaries would receive a benefit for life as well. And that is something to be proud of as a member of TRS. And also it's based on a TRS formula. This is something that you have control over. It's based on the number of years that you work and your salary. So you work as long as you need to put you where you want to be in retirement, and you look for promotional opportunities at the end of your career. So also in this main section, we're going to talk about that benefit formula in details. We're also going to talk about eligibility rules, and we'll also talk about or see an actual benefit estimate. This is something that you can request from us via phone, via website. We can prepare these benefit estimates for you guys. When we come out to your county and meet you one-on-one, you will be able to receive one of the benefit estimates that we'll talk about. Now, here is our formula that we use at TRS. It's really, really very simple, this TRS formula. What we do is we look at your years of service, we multiply that by 2%. So if you worked your 30 years, you multiply that by 2%, that's going to give you 60% of your 24 months of consecutive salary. We come up with an average for that. So the longer you work, the more money that you can receive in your benefit. So you can work up to 40 years. That's my goal, is to at least get to 40 years. So that means that I would get 80%. But if you decide that you want to work 25 years, and you're age 60, that's 50%. So you decide what it is that you want to receive in retirement. We look at 24 consecutive months. People ask, is that the last 2 years? Well, if you received a raise in September, we will start counting in September, 24 consecutive months. So it's not necessarily the last 2 years. It's wherever that high salary falls. So if you're working in a position that's paying you $60,000 a year, and then you move to another position that's paying you $40,000 a year, we're going to find where you had your 24 months of consecutive salary, and that would encompass that $60,000. Also, once you get your gross benefit amount calculated, it's subject to federal and state tax. So when you're looking at the benefit, and I'll show you that in the estimate, how you can plan and look at what your gross benefit will be and what perhaps is your net benefit that you would take home. Now, the first thing, what people want to know, am I eligible, or when will I be eligible for retirement? Well, under a normal retirement, and what a normal retirement is a retirement without a penalty. So if you have at least 30 years of creditable service, age 60, well, no, if you have 30 years of service, regardless of your age, then you're eligible for retirement, or if you have at least 10 years of creditable service and age 60. So that's what we call a normal retirement, because it does not involve a penalty. Also, under that category is disability retirement. Under disability retirement, you have to have 10 years of creditable service and cannot perform your job. Now, Cindy talked to you about it being a little difficult, time-consuming to get a disability retirement under Social Security. What we have is a panel of 3 physicians who will look at your medical records and determine whether or not you can do your current job. So it's not like, well, you may not be able to teach, but can you work in the call center? We do not look at that. We do not look at it that way. We're actually going to look at your job duties and determine if you're unable to perform that job. Also, we have people who just can't take it anymore. They're just ready to leave. You know, it's the stress of these new age children. And not only that, it's also the stress of doing all of the administrative work. So for whatever reason, and you just have to go, you can do that. But you have to have at least 25 years of service, but less than 30, and are under the age of 60, because that's our normal retirement criteria. But it costs you. So you may want to take an early retirement simply because you want to start another career and they're going to pay you out or something, so that you can, take that position and leave early. But we look at a monetary penalty. So if you are, an example of that would be if you are 59 years old and you have 25 years of service, where you're 1 year away from age 60. Okay? So that means that there's going to be a 7% penalty. But if you're 52 years old and you want to retire with 25 years of service, that's 5 years away from 30 years. So that's a full 35% penalty. And so you have to decide, is it worth it? Can I just see a little bit of the light at the end of the tunnel and I just hang in there a little while to keep it done? Just get to my 30. Also, you're not eligible for a cost of living adjustment until you would have reached a normal retirement age. So if you are 55 and you have to wait the 5 years, you will not get that cost of living adjustment until you would have reached 60 or would have obtained 30 years of service. So that's really something that you want to think about. Another thing that you may want to think about here is just freezing your retirement. I have my 25 years. I'm 55 years old. I do not want that penalty. I will freeze my retirement and wait until I'm 60 to draw my benefit. At that time, I'm under a normal retirement, so there's no penalty involved. But the thing is, what about your health care, your health insurance? Are you still going to be able to maintain your health insurance? But if that's taken care of, that may be an option for you to just freeze it. But it does come with consequences. So at TRS, we have two different plan types. We have plans that do not leave a monthly benefit, and we do have plans that will leave a monthly benefit. It is very important for you to look at what your own individual situation is. Most people ask us, well, what's the best plan? What's the best option? We can't tell you that. It's a lot of variables. Will I receive Social Security? I know that some of the people in the room will have that windfall elimination. What other provisions have I made for my family? Do I have this huge life insurance policy? What do I have? And once you realize what your income will be, what provisions that you have made, you're in a better position to determine what plan option would be best for you and your family. Now, most of the data would suggest that you need 80% of your income in retirement. I think it's 100. 80%. You having this income level, you're going to retirement. You may or may not have a Social Security supplement. So where does that money come from? Do you have at least 3 streams of income? Are you only going to get your pension? How are you going to manage that? So those are things that you start thinking about now in getting ready for retirement. So let's go over these plan options, but before we do that, I wanted to just give you this visual, because I'm a visual learner and it helps me to understand. So if you look at this first bucket, this is your bucket of money that consists of your contributions and your interest that you've been putting in each month. So that's your bucket, and you're entitled to receive everything that you've put in during the course of your career. That's your bucket, you own that. That second bucket to your right is what your employer puts in on your behalf. That bucket should be about 3 times more because you're putting in 6%, your employer is putting in about 19%. It keeps going up for them, but it stays the same for you. So we take your money, the employer's money, and then we make investments. So we have this money tree. And when you think about a money tree, you think about that never runs out. It never runs out. I know when you were young, your parents was like, do you think we have a money tree in the backyard? Well, TRS have a money tree. So, and the good part about it is that it's guaranteed by the state of Georgia. So if there was something that happened with TRS and we were not able to pay a benefit, guess what? The state of Georgia takes over and will pay you this benefit. That's why we guarantee this benefit for the rest of your life. It's a wonderful benefit that you have with TRS. So let's look at those plan types that we talked about. And just keep in mind your bucket. Under Plan A Maximum, that's the largest amount of money that you can receive from our system. So for example, you have your 30 years, you're getting 60% of your salary. That largest is based strictly on the formula, the largest amount that you can receive. You will receive this benefit for the rest of your life, even if your bucket runs out. You're going to receive that benefit for the rest of your life. When we look back at the bucket, because you're guaranteed everything that you've put in, if you're receiving that maximum benefit and something happens to you 6 months later, untimely, and there's still money in your bucket, it would be paid out in a lump sum to your primary beneficiary. It is not designed with the beneficiary in mind, but you are entitled to everything that you've put in plus interest under that maximum plan. That's the largest amount. We also have a Plan B option one. Plan B option one. Under this plan, what we do is we reduce your benefit, and you'll be able to see an example of that. We'll reduce your benefit, but what happens is we're looking at that bucket of money. So you have this money in your bucket, and so we're not taking out the full 100%, where it would take about 2 to 4 years to deplete. We're looking at taking out 20% of this money out of your bucket, so it extends the time to about 14 years to keep it, 10 to 14 years to keep it in your bucket. So after 6 years, something happens to you untimely, there's still money left in there that would be paid out in a lump sum. But you're taking a reduction to be able to do it. So when you're looking at Plan A Maximum, the largest, the money runs out in about 2 to 4 years, but you get it for life. So don't think that after 2 to 4 years, you're no longer getting the money. It's just that your bucket is empty. Under Plan B Option 1, it takes 10 to 14 years to deplete what you've put in. So imagine under that maximum plan that you're in a plan, a pension plan that runs out in 2 to 4 years. Now, if that doesn't make you excited to be a part of TRS, I don't know what is, because you're going to get that for the rest of your life. And I cannot say that enough, because that is a major thing in today's economy to be able to do that. Now, one thing about these two plans, they're called non-survivorship plans. What happens is that, if you see the bottom part, if you choose one of these plans and your spouse can continue on with your health insurance coverage, they'll go to the single coverage and they can send that payment in monthly, because there's no monthly payment being sent out, no monthly check being sent out. But if they remarry, then they will lose their health insurance. And so and we have a little solution for that you may want to consider, but this is something that you should know when you're choosing those non-survivorship options. Now we go to the survivorship plans, and this is a visual for that. This is like a little seesaw. So if you're going to leave someone a benefit, you're going to get your money a month, and then if something happens to you, they're going to get a benefit. Well, that's going to reduce your monthly benefit from the maximum plan, because it's based on your age and your beneficiary's age at retirement. So you'll see somewhat of a reduction based on that. So let's look at that. Our first plan is Plan B Option 2. Under Plan B Option 2, you'll take a reduction. But what happens is that if you're receiving $2,000 a month in a benefit, and something happens to you, then your beneficiary, your primary beneficiary, could receive 100% of what you receive for the rest of their lives. So they will continue to get the $2,000. And you can have multiple beneficiaries under Option 2. We also have Plan B Option 3. Under Plan B Option 3, what happens is that you receive more money up front, but in the event something happens to you, your primary beneficiary will receive 50% of what you receive for the rest of their lives. There again, we're looking at our members, your age at retirement, and your beneficiaries, because sometimes people want to add a grandchild. Well, if you add a grandchild, they're much younger and we're gonna pay them longer. So those are things that you're going to consider when you're choosing your option. In addition to that, we have what we call pop-up options with our option 2 and our option 3. Under the pop-up option, what happens is that in the event your primary beneficiary predeceased you, you're able to pop back up to our maximum plan amount. So if that benefit, taking the survivorship benefit, caused you to lose $300, something happens to your primary beneficiary, you're able to make up that $300, have it added back. You can only have one primary beneficiary to do that when you're taking a pop-up option. So your choice is, will I take option 2 pop-up, which is 100% payout, or will I take option 3, which is a 50% payout? Those choices are up to you. And our last option is option 4. With option 4, you can customize the benefit. So if you say, you know what, we've done a budget, we've looked at it, and you need $800 a month. So I'm gonna leave my primary beneficiary $800 a month, or I'm going to leave them 25%. You can select what you want to leave that the benefit as. And then this is also an alternative to those non-survivorship plans. Remember, under the maximum plan and Plan B option 1, if the spouse remarries, they lose their health insurance. Well, if you just say, I'm gonna leave $200, just to make sure that if something happens to me and my spouse starts getting that $200, he's having a survivorship benefit, which would include the insurance, then I can select that and he can remarry someone else and get that health insurance benefit. And we know how valuable that is, health insurance. So this is an alternative to that. Okay? Now we're gonna have a test, because I need you to understand the importance of making a decision that applies to your situation. So think about these 3 questions. Mary has no dependents and no one depends on her income. So what would be the best option for Mary? Plan A maximum, that is correct. And why is that correct?
It doesn't matter what's left of the income.
Right, nobody's depending on that income, so that is correct. Number 2, Sue has a spouse that has no savings and will not receive a pension or Social Security benefits, and who has lousy lotto luck. Now, what would be the best option for Sue? Plan B option 2, because, well, maybe pop up, but Plan B option 2 because he has nothing. And she knows who he is, that's a man. She wanna make sure that he's taken care of if something were to happen to her. So, that would be her best option. It may not be for anybody else, but that's for Sue, is looking to take care of this person who does not have his own stuff. And, and so we have another option. Tom has a spouse who will be receiving a pension and Social Security, but the amount is $500 per month, short of meeting her income replacement needs if Tom dies first. What's the best option? Yes, the one that you can customize. Option 4, you've done your budget, all you need is $800. Put that in there because you've done the budget. I keep talking about budget because it's so important to do your budget. So that's how you look at your plan. Our most popular plan is our maximum plan. But when something happens to our member and that spouse calls our office saying what happened to the check, then we have to say there was no survivorship plan listed. So you just have to make sure that once you make your selection, you choose the plan that's not only good for you, but your family as well, and they are aware of it. Now, after looking at those 7 plans and trying to decide what is best for you and your family, we have what we call a partial lump sum option plan. And we just simply call it plop because we're just plopping money down to you. You can choose, if you're retiring under a normal retirement, you can choose anywhere from 1 month to 36 months of your maximum benefit in a lump sum. So if you were getting the $2,000 a month, your minimum would be $2,000 and your maximum would be $72,000 that you can receive with your first check. But you need to think about that because if you're getting a plop and you're getting it in your hand, it's subject to what? Taxes. It's also counted as what? Income. So that's something that you want to think about. And so what happens is you may want to have it rolled over. And you really, really need to talk to a financial advisor if you're considering a plop. I know someone personally, when we first started allowing our members to receive a plop, who got so excited because she could get $130,000, and this guy told her that he can help her make money on top of money on top of money. And so when she took out that 130, she wouldn't listen to me. I don't know why, she just wouldn't listen to me, but she lost her money. So she had to go back and work because she had this dream of making all of this money off $130,000. So if you're thinking about that plop, then you really need to talk to someone. You get $10,000. Federal tax, state tax, the penalty is treated treated like retirement funds, so there could be a penalty involved. So is that something that you want to do? And just to note this, to replace the income loss from a plop, you would need an annual return of over 11%, assuming retirement at age 60, with 3% COLAs over a 20-year period. A $65,000 plop taken at age 60 is a $150,000 reduction in total benefits paid over a 20-year period. So really talk to a financial advisor if that is something that you want to do. Also, when you're receiving your benefit, you may be eligible for a cost of living increase. We do those cost of living increase twice a year. It's 1.5% January, 1.5% July, if you're eligible. We're also looking at when you are retiring. If we're looking at the first 6 months, January through June, then you're going to receive your COLA the following January. And then if it's the second half of the year, July through December, then you'll receive the first COLA the following July. We have a lot of people who are 12-month employees, and what they want to do, they're looking at the COLA. Let me just go out in June so that, or April, so that I can get my COLA the following January. Well, think about if that's your high salary from May and June, that's 2 months of high salary that we're not even calculating, so you can get that 1%, 1.5%. So always, when you're looking at when you're going to get your COLA, get an estimate from us to see if that would really benefit you to go out early and missing having that larger income in your lifetime benefit calculation. That's just something that you want to think about when you're looking at COLAs. And this is an example of our basic benefit calculation. This is showing a date of June 2025. That high average salary is $5,833. And so that occurred between June 2023 And we've projected through May 2025, because that's what we do. We project. If you want an estimate in the future, we will project it out based on your current salary. And so that's our simple formula. It's not difficult. It's not this and that and all of that. It's simply your years of service multiplied by 2%, and then your high average salary to come up with your gross salary under the maximum plan. So you set your goal in what you want to receive in retirement. Now, this is a benefit estimate. How many people have received a benefit estimate? Okay. Well, most people in the room said you were within 5 years. So if you're within 5 years, I highly recommend that you get a benefit estimate now so that you can plan. At the top of the benefit estimate, you'll see the estimate information that we use to calculate what your benefit will be. It'll tell you what your average salary from and to date is. So you'll know that we're calculating that year. If it's a year you say, no, my high salary was actually in 2012. Something's wrong here. So we can look at that again, so you make sure that you pay attention to that. Also, anticipated total service at retirement. If that's where our formula come in. This person has 30 years. That includes some anticipated sick leave, which we'll talk about a little bit later, and it's showing that they're going to get 60% of that average salary under the maximum plan. It also shows the plot minimum and the plot maximum that that person can receive. That's what you'll receive on your estimate. Now, this is the part that I have everyone look at. And that's that bottom part, because it's showing your gross monthly benefit amount based on your salary and service of what you can expect to receive at retirement, along with what your beneficiary would be able to receive. So this member is receiving the $3,500 a month. You know, I talked about the slight reduction for Plan B option 1. You see the slight reduction there. But when you look at the 100% payout, which is Plan B option 2, it goes down. The pop-up, Plan B option 2 pop-up, it goes down even more, but this member would be able to pick up that difference and they would pop back up to the maximum plan. So you get to see under each option, even though there are 7, it gives you an idea of what you're working with. And so not only are these gross benefit amounts, because a lot of people look at the gross benefit amount and say, you know what, that's doable. But we're going to take out federal tax, we're going to take out state tax, and we're going to take out health insurance. So if you're looking at Plan B option 2 because you want to leave the 100%, by the time you take out federal tax, state tax, and health insurance, how much you think that would be? Okay. It's going to be much lower than that, even after 30 years of service and a decent salary. So you really, really need to look at these plans and the benefit amounts when you're planning for retirement. And so here's our recommendations. Start thinking about what option is best for you and your family. This is where I suggest you sit down with your family member and you do a budget. When you do that budget, you can determine, am I going to have Social Security? What other streams do I have? Will I have a monthly Social Security check? Will I have, what else will come in? And once you do that, you're in a better position to choose what option is best for you and your family. And I also make a suggestion, too, is once you get those figures of what you potentially could receive in TRS, live off of it 3 to 6 months. If that feels good to you, okay, I can do this. Then you're okay. But if you're saying, wait, I didn't know they were going to take that out. I didn't know that this is what I would bring home, and I don't have anything to supplement it with. You know, you're right now, if you know that you cannot make it off of the option you need to choose for your family and it's lower than what you expect, what can I do now to eliminate some of the debt that I have? So if I need to have $3,000 coming in each month, but my check is only going to be $2,800, where's the other money coming from? Maybe I can eliminate a couple of monthly expenses that I have so that it'll be comfortable in retirement, because when you get ready to retire, you can go back to work, but you don't want to have to go back to work because you didn't plan and you didn't calculate correctly. We also suggest and recommend that you generate your own benefit estimate. It's easy. If you're within 5 years, you can generate your own benefit estimate, give you some idea of what you can receive in retirement. And like I said, ask for a benefit estimate if you are within 5 years. It's so important for you to see your actual numbers. How many people have seen your actual numbers? See, very few people. So look at those numbers so that you can be prepared for retirement. And once you're within 2 years of retirement, schedule a one-on-one. We will show you your numbers. We would have completed an audit of your account so that we have the salary correct, and it's a closer estimate because we've looked at it. So that is our recommendations for you. And so now we'll talk about creditable service, because that's what's going to get you to your 40 years, your 30 years, or whatever your goal may be. It's going to get you there. And so there's 3 ways to earn credit, creditable service, and that's membership service, unused sick leave, and purchase service. So let's look at those. For membership service, that's what you're doing now. You're going to work every day. You're earning service credit by being a member of Teachers Retirement. And it's awarded in 1-month increments. So you work July, August, September, you're a 12-month employee, you're getting those 3 months. The thing is, whether you're a 10, 11, or 12-month employee, we're looking at a fiscal year from July through June. So as long as you earn 9 months during that fiscal year, you're going to get 1 year of service credit. But the best part about the 12-month employees, you're still earning additional sick leave credit. Now, if you're a faculty under the Board of Regents, as long as you have 8 months, that is 1 year. So that's how you're accumulating your membership service. The other way is unused sick leave. Imagine you have that 29 years of service, you're 55 years old, you just need 1 year, but you have enough sick leave to get you to a year of service. So it depends on your contract type, how much you can accrue. So if you're under a 10-month contract, it's 12.5 days. It's the maximum you can earn. 11 months, 13.75 days, and 12 months, 15 days. That credit is awarded retroactively after retirement. So what happens is we don't want to hold your retirement check up, so we're going to give you the check without the sick leave. And once we get the sick leave certified, then we're going to send the supplemental check, and after that, then it'll be all merged together. And so that's why it has to be retroactively, because we don't want you to be waiting on your retirement check, okay? Now, we also got questions about what if the system that I work for do not have records. We just do a little formula because we want it to be fair. So just say you were working in Whitfield County for 10 years and you have 100 days of unused sick leave. And then you worked for Bartow County and they did not have records for 10 years. What we're going to do is do an averaging, so you'll get the 100 days based on the records that we have in Whitfield County. You'll get the 100 days of unused sick leave. That makes sense, right? That's the only fair way to do that because they were not required to keep records of unused sick leave. And this is our sick leave chart. So how many days do you have to get a year of service credit? 170 to 189, which is correct. If you have that, you have a year. A lot of people think they have to have 12 months. No, you only have to have 9. So if you have 12 months, that's going to give you an additional 1 year and 3 months of service credit. So that's something to think about in terms of holding on to your sick leave, because it becomes valuable when you're looking at a penalty. So these are things that you can do, is to go ahead and get your sick leave certified. If you've worked in another county, go ahead and send those sick leave forms in and have it in your record, so it will not take a long time to get that supplemental check to get your sick leave together, because we cannot receive your unused sick leave from your current employer until you have terminated your employment. Okay? So let's talk about other ways that you can receive working, getting your sick leave. You can also purchase service. And we have service that you can purchase. So think about what you've done in years past that you may be able to purchase, because a lot of times what you're trying to do is to get out of a penalty. And you're not obligated to purchase this service, but you can go ahead and get it certified so that it'll be in your file, and we'll do you an estimate with and without the purchase of service, and then that way you can see whether or not you can recoup your money in a timely manner. If you can recoup your money in 2 years, it may be worth it to get that service certified and purchased to add to your retirement. Our most popular service is our TRS withdrawn service. It's when you worked in a TRS covered position, you left and you came back, and you worked 3 years, you can reestablish that service. We have a member's guide on our website that you can see all of the service purchases that you may be eligible for, and that withdrawn service is just our most popular. Our out-of-state service is another popular one, but it takes a while because it has 3 moving parts. So imagine you have to fill out the form, send it to the system, they complete the form, and then you have to send it, they have to send it to us. So you have to track it. And I think the longest one that I've had to deal with personally, we've gone back and forth, and it took about 5 years. So if you have out-of-state service that you may want to purchase, you may want to go ahead and get that certified now. Because if you get it certified now, you can decide if you want to or not. You don't want to submit your paperwork, and we're waiting on out-of-state service to be certified. And one other thing that's not listed up there is airtime, which is popular to keep you out of a penalty. What airtime is service that you can just purchase. You didn't have to work for it. You didn't have to earn it any kind of way. You can purchase up to 3 years of airtime. And this is to keep you out of a penalty. And so you have to begin to decide to buy or not to buy. Will it allow me to retire earlier? Because I have 29 years, I have a year's sick leave, or I have 2 years of previously withdrawn service, and I'm at 28 years, I can purchase that service to get me my 30. And so if you're going to purchase that service, remember that price increase each month. The interest is compounded daily. So if you ask for a cost calculation, we're going to give you 4 pay dates, and on those 4 pay dates, it's going to go up a little bit each month. So those are things that you want to think about in purchasing service. Our recommendations: send your sick leave forms to your former employers. Review your work history. Did you work somewhere else? Can you remember? I remember working here, but I don't see the time. When I look at my member statement that I get every year, I don't see this service on there. Go ahead and get an updated cost calculation. And don't end up delaying your retirement by waiting too long to start the paperwork. Now, this is a biggie for us at TRS because we had a lot of issues surrounding the beneficiaries. We have what we call primary beneficiaries and secondary beneficiaries. And so we're going to go into that, and we're going to talk about the death and active service, death and divorce and retirement, and our recommendations on that. So first of all, let's talk about the primary beneficiary. The primary beneficiary is the one that will receive a benefit from you. So if you have a spouse that's your primary beneficiary because they depend on your income, that's your primary. Or it could be a child that you want, that's all you have. You don't have a spouse, you don't have anyone else, so you're naming a child. But this is the person who will receive a monthly benefit if you pass away. Our secondary beneficiaries are there just in case that something happens to our member and our primary, and there's still money left in that bucket, and they would receive it in a lump sum payout, your secondary beneficiaries. So let's look at death and active service, because if something were to happen to you today, what happens if something were to happen to you today on your way home? If you're not vested, this does not apply to you guys, because everybody in the room raised their hands when they said if you're 5 years out. So I'm thinking at least you have 10 years. But if you're not vested, then your beneficiary will receive a lump sum of your contributions and interest. But if you are vested, your primary beneficiary can choose to receive Plan B option 2, which is that 100% payout, or they can choose a lump sum. It's so important that you talk to your beneficiaries about what you have at TRS. And I'm just gonna share this because I think it's so important, because I did have a young man come into the office and his mother had died in active service. And so when he saw, he was maybe 18, 19, and he saw $125,000 in a lump sum payment, you know, he had a choice to choose the lump sum or the monthly payout. He was thinking that he should receive that lump sum because that was a lot. Well, I mean, it is a lot, but that was a lot to that young man. And so you don't want your loved one, if they are a young person, as your beneficiary, to come in and take a lump sum payment. Well, fortunately, after showing him an estimate of what he could get for the rest of his life, because we can't tell him one way or another, but showing him the estimate, he decided to continue to receive a monthly benefit for life. And that young man has been, and this was early on in my career, so this young man has been receiving a benefit for about 20 years, which way exceed that $120,000. So tell them the value of what you have at TRS. That's so important. Don't go up there, if something happened to me, and get all that money. Buy you a car, and then there you are, don't have much of anything. So those are just things to think about. Now, let's talk about death and divorce and retirement. If you select option 2 through 4 and only have one primary beneficiary, if that beneficiary dies before you, you can change your beneficiary and or plan, but not to the maximum plan, unless you elected the pop-up option. So that's, you have a choice to choose that pop-up option when you're selecting your plan. If your spouse is the beneficiary and a divorce occurs, you can change your beneficiary and or plan. When I first started, you couldn't change it, even if it was a divorce. So that was some good legislation, right? If you select a new beneficiary or a new option 2 to 4, your benefit will be recalculated. So now we allow for it to be recalculated. And so if you have 3 beneficiaries under option 2 and there's a divorce, and then you can recalculate the children. Okay. And we'll talk about that in the multiple beneficiaries. So when you have multiple beneficiaries, the father, the 2 children, or 3 children, or whatever, if you select that 2 through 4, If any beneficiary dies before you, you cannot change the plan or remaining beneficiaries. Benefit percentages are not adjusted because that's the plans that you had. You chose that option with 3 primaries, and there was, if something were to happen to you, they still receive the same amount. But if you divorce, that's what I was mentioning earlier, you may remove the divorced spouse as beneficiary. You may reallocate the benefit to the remaining beneficiaries, but your retirement benefit will be recalculated. So if you have the spouse, there was a divorce, you can change it to 50-50 for the children. If you were getting that $2,000 a month, it's going to always be lower. So what you want to do if something happens and you're trying to change it, get an estimate from us to see how much your new benefit will be, because it will always be lower, and to decide whether or not you want to keep your current benefit and just not make any changes at all. So that's an option for you as well. The beneficiaries are based solely on the beneficiary information to file at TRS upon your death. So we talked about wills and trusts and all of that earlier, but what's on file at TRS is what will stand. And it's okay to designate minor children. Reason being, if just say you have a 6-year-old child and you have your sister as the primary beneficiary, something happens to you, your sister received the benefit on that minor's behalf. What happens if something happens to the sister? What happens to that benefit? It stops. It stops because the child is not the primary beneficiary. So that's something that you want to think about. If you're choosing, you have a child, but you're putting a relative as your primary beneficiary, and something happens to them and all the money is gone out of the bucket, it just stops. And if you retire and die within 30 days, your current beneficiary may choose your contributions and interest or option 2, but that's if that primary dies within 30 days. So those are things that you really, really want to consider when you have someone who's dependent on your income. So our recommendations: review your current beneficiaries. Are they up to date? We just went through a period of COVID. And when we went through that period of COVID, we had several calls to our office where the beneficiary was not updated. So that's where you have those ex-wives, ex-husbands getting a benefit because it was never changed, because we have to use what's on file. That's when you have the mother that when you started out as the beneficiary because it was never updated, who has passed on, or you have the sister who you weren't married at the time and you didn't update it. And so those are the ones who are entitled to a benefit. So what I would suggest that you do is to go online tonight, if you have not done so, and check to see your current, who you have as your current beneficiary. And if you need to make changes, then you need to make those changes. And you can distribute, if you have multiple beneficiaries, you can distribute them at whatever levels you want. You can say 33, 33, 34, 10, 75, whatever adds up to 100. It just needs to add up to 100. So you want to make sure that everything is up to date. And then there's some people who just don't have anyone to put down as a beneficiary. So if that is the case, write down Candice Jackson, okay? Just put me down. Just put me down. But honestly, you want to make sure that someone benefits from the hard work that you've done all of your life. So make sure that that is done, and you can do it online. And so we come to the part here where there's the wrap-up and steps to consider today. Visit our website. You all would be so surprised at how our communications division has grown. We have podcasts with a lot of information. We have videos with a lot of detailed information. We have newsletters, all of that information available for you. We want you to log into your account and schedule a one-on-one counseling session. It's very important that we sit down with you and look at your numbers and talk to you about them. And again, update your beneficiaries. And consider hiring a licensed financial planner for individual advice, because they will put all of those pieces together. Look at your estate, what you have over here. Do you have a 403B? Well, how are you supplementing your income? They can look at that. Your payments are direct deposited monthly into your account. So, once you retire, you don't have to worry about a paper check. We are going to deposit those into your account. And we're always looking for feedback. We want you to go to our various sites and put your feedback, do your feedback, because we want to know, how did we do? Are we giving you the information you need that can assist you in successfully starting to think about retirement and having workshops like this that will effectively help you plan for retirement along with the state and Social Security? You can follow us. See, we're all over the place. We are just, we have all of these avenues for you, which is the Facebook page. We're constantly posting content. And we're even getting ready to move into AI. I'm excited about that. We're going to be doing some things where we have avatars. Our director is on the ball. So we're really, really excited about that and what you can see coming to TRS. So I'm going to leave this up so that you can, scan these codes even afterwards, so that you can go to one of our sites.